All the delegates on the panel discussion. The topic is strengthening risk management and capital optimization capabilities to manage increasing stress on asset. It is one of the hot topics in banking circle today. And to discuss this topic, we have a panel of eminent panelists. For this, I welcome, first of all, Mr. B. Mahapatra, Executive Director, Reserve Bank of India. Request to Mr. Mahapatra to come and occupy his seats. Next on the panel is Mr. R. Venkatachalam, DMD, State Bank of India. Mr. Venkatachalam, please. And we have also on the panel a person from the banking circle or from other circles. So I welcome Mr. Arun Thukral, MD, CIBIL. Mr. Thukral, please. I also welcome Mr. P. Rudran, MD and CEO of RCIL. Mr. Rudran, please. We also have on our panel Mr. Mohan Jayaraman, MD, Experian Credit Information Company of India Limited. We also have on panel Mr. Arun Srivastava, Executive Director, Bank of India. Mr. Srivastava, please. And to carry on the discussion and take an active participation, we have Mr. Andreas Kramer, Expert Associate Principal, McKinsey & Company Limited. Mr. Kramer, please welcome. Now, to take forward the discussion, I request Mr. Mahapatra to carry on the proceeding. Mr. Mahapatra, please.
Good morning, ladies and gentlemen. It gives us great pleasure to be the panelist for this important topic, very long one, strengthening risk management and capital optimization capabilities to manage increasing stress on assets. We are lucky that we have eminent people on the panel. We have Mr. Andreas Kramer, Junior Partner in KPMG. We have Mr. Arun Thukral, MD, CIBIL. We have Mr. Venkatachalam, DMD, State Bank of India. We have Mr. Arun Srivastava, ED, Bank of India. We also have Mr. Rudran, MD, RCIL, and Jairam Mohan, MD, Experian. So with this panel, I hope we'll try to do justice to this topic today. As a chairman, let me try to introduce let me try to sensitize you about the issue that we are facing today. My first slide will be a big picture. The asset quality of the banking system in our country. It's an issue now, but we have lived with it in the past. Not that the asset quality issue is something new to all of us. When we implemented the new prudential norms from 1991 after Narasimhan Committee recommendations, if you apply the new norms, probably the Npls in those days were around 24–25%. But if I go to recent past, from 1997, if you see, it was around 16%, but we managed it very well, and around 2007 or 2008, we came down to 2.4 or 2.5%, the gross NPLs. But after that, after 2008, there is a steady increase in the gross NPLs. The point I want to make is that the issue is not new to us. Yes, it was there with us. We managed it. We came down to a very good, reasonable level. And again, the ugly head of NPLs is going up. Second point I want to say, same thing in a different format. The blue line is the gross NPLs, which is going up to 4% as in June this year. The net NPLs, which is the red line, which is now 2.13%. But the green line is slightly disturbing. We used to have good provision for the NPLs. In any business, things will go bad, sometimes or other. But if we have provided for the bad times, probably we are immune to those bad elements. But here, what I want to say is that the provision coverage, which we had almost 54% by March 11, is coming down to around 47% now. So that is a weak spot we must identify. Again, same thing in a old wine in a new bottle. What I'm trying to say, the blue line is the growth in the gross advances of banks. The gross advances of banks is increasing at a pace of, let us say, 15, 16, 17%, or 19% some years. But the red line is the real red line. The growth in NPLs is really going up. I mean, from March 11 to March 12 by 45%, March 12 to June 12 by 50%, so on and so forth. So around 40, 45, 50% NPLs are rising over the years. And if you see the different sector of banks, public sector, private sector, in private sector, new generation private sector, old generation private sector, and the foreign banks, again the distribution is very asymmetric. It is not uniform of this 4% gross NPLs, all banks at the same level. No. Probably public sector banks are more affected. The red line is for public sector banks, 4.59%, whereas the new generation private sector banks are least affected. Probably they are between 2% or around 2% or so. So we also must recognize that there is some problem in public sector banks. Again, I talked about NPLs or NPAs, but in the meantime, we have something called a strange animal called restructured standard assets or restructured standard loans, which are not included as NPLs, but there is some stress in those assets. So we also, some people, some analysts try to club it with NPLs and call it stressed assets. If we include the stress as the restructured standard assets with the NPLs, the figures, I mean, 5.87 is the restructured standard, whereas 4% is the NPL, so it goes to 9, 10%. So the stressed assets in the system is around 10%, system as a whole. Some banks may be more, some banks may be less. My color choice is very deliberate. By putting green color for restructured standard assets, I am not raising the red flag. So, okay, things are bad. Some assets have been restructured, but there is hope. I mean, not that they are fly-by-night operators, not that there is no real asset in the system. Roads are there. Maybe the last mile has not yet been constructed. Plants are there. Maybe toll is not there to start the operations for producing powers. So real assets are there. I mean, they are not in thin air. They are concrete, very much on the earth, embedded to the earth. So they are very much there. So that's why my feeling is they're still green. Yes, some stress is there. And the NPLs, I didn't make it red, it's blue. I mean, blue state. We were in a blue state of affairs. Don't worry. I mean, things are, there is some issue, but it's not panicky like in 1997 when NPL itself was 16%. Again, same thing in a different bar chart. NPLs, and the top of it is the restructured standard assets, but giving bank-wise. All banks, if you put, I told you, will be 10%, but if you see only public sector banks, it is 7.34 is the restructured standard, whereas gross NPL is 4.6%. So they are much ahead of other group of banks. New private sector banks are least affected. Old private sector banks are somehow affected, but not like public sector banks. And foreign banks still lesser, or they are almost like new private sector banks. Again, it is the same, I mean, no, this slide talks about the CDR, the corporate debt restructuring, how many assets or what the value of the assets, those have been referred to and those have been approved at the CDR level. Again, if you see, till March 10, 11, things were manageable, around 1 lakh or 1,10,000 crore. But now, if you see, things are quite, out of control. somehow it has gone up to 2,72,000. This is only CDR, not the restructuring that banks themselves do bilaterally. If you put both together, maybe it might exceed 3,25,000 crore. And the sectors which are most affected, as you know, mostly iron and steel, infrastructure, textile, power, and telecom. And to my mind, all are infrastructure sector. All are part of infrastructure. I mean, iron and steel, you may not call infrastructure, but they are basic core industry. The point I was trying to say that they are all real assets. They are not in thin air. They are very much embedded to the earth. The factory is there, the plant is there, the road is there, but probably the last mile connectivity is not there. Probably coal is not there to run the power plant. So, I mean, they are all very much, real in the sense real. Profitability, it has not impacted the banks so far. The NIM of around 3%, all banks have maintained 3% NIM, and the return on asset also around 1%, which banks have generally maintained, except for public sector banks, for which the ROA has come down, but NIM almost everybody has maintained around 3%. So impact on profitability is more for public sector banks than so for other group of banks. Again, RBI's financial stability report, which came out last June, every 6 monthly we publish in June and December, it also stressed the stressed assets of the system and came to a conclusion that even if some of the restructured standard assets become NPLs, things will not go out of control. Particularly if you know, we have taken care of the restructured standard assets by putting in place some new guidelines in the May this year, end of May this year, by means of which there are 2 or 3 things I want to say that we will tolerate a bit of restructuring. We will give the regulatory forbearance for some more time. That is the loss or the sacrifice that we as regulators are willing to make. But you as banker should also be willing to make a bit of more provision. So provision has been hiked from 2%, then 2.75, now to 5% for the new assets, and for old ones in a staggered manner over 2 to 3 years. And the borrower also should sacrifice. He should bring in more equity. The borrower should sacrifice more. The borrower should give a personal guarantee. So it is a loss-sharing arrangement that in a system when there is a problem, all the stakeholders should share the loss. Not the burden should come only on the banks or only on the regulators or only on the corporates. And capital level, yes, there is some stress. I mean, the ratios have come down over the years, over the last 2 years. Tier 1 ratio, then total capital ratio, it has come down. And if you see the bank group-wise, public sector bank is more stressed than foreign banks or other group of banks. Sorry, I don't know how this thing came. Okay, please. Oh, sorry. What is chip? Escape. Oh, escape. Yeah, good. Thank you so much. So there is some, capital level, but all the banks are operating much above the minimum regulatory requirement of 9%. So I cannot say that the bank is not complying with regulation. Banks are complying, very much complying with regulation. They are much above the minimum requirement. I don't want to go into the regions and all that because I have a eminent group of panelists. I will stop here because I know after me you will have a very beautiful presentation by Mr. Andreas Tremer. He will give a good presentation about what is the problem, what is the system, and what we are about to do to tackle this situation. Then Mr. Arun Totral also will talk about how at the retail level NPLs have been mostly tackled because banks have depended on the credit information report from the CIBIL and other CICs. And Mr. Venkatachalam, DMD of SBI, he will talk about, he's one of the biggest banks in the country, SBI, and how NPAs to be controlled and how capital can be optimized to take care of that. because we are heading towards, or we have already started implementing Basel III, so there is a pressure on capital, and if there is a pressure on NPA and capital both, then how to balance the two and how to move forward. Mr. Arun Srivastava, ED, Bank of India, he also talked about the initiatives taken by their bank and other banks in arresting the slippages into NPA. Mr. Rudran, who is the MD of the RSIL, the largest asset reconstruction company, he will talk about how recovery can be done and how asset reconstruction companies can play a role in this stressed scenario. And Mr. Jairam Raman, he's also MD of Experian, a credit information company. He also talked about, again, why retail and SME, they are mostly pioneering in SME and retail segment, and how credit information can help in arresting these NPLs. I'll stop here. I'll come back to you after each panelist introduce their topics for some time. Then I'll again come back to you. Thank you so much. Mr. Andreas. You have to change.
You need to switch it on.
Yeah.
This one. Thank you. Yeah, thank you, Mr. Mahapatra. Thank you very much for joining this panel on risk management and NPAs. As you rightfully said, and thank you very much for your very insightful presentation about the history and the current status of the economy, NPAs are a very important topic for India. I was quite impressed seeing actually the decrease in NPAs that you have managed over the recent years. That's really impressive. I wish a lot of European banks would be able to do the same. Unfortunately, they're not. But there's a risk in the economy right now, as you all are aware of, that the NPAs are going up again. And what I would like to share with you is a bit of our perspective, of McKinsey's perspective, first coming from a survey that we have conducted amongst all participating banks in this conference. And we're going to show you some results, and we're happy to share some more results with the participating banks after the conference in the coming weeks. But also, I think more importantly, sharing some of the recipes that we have seen international banks and local banks, and particularly local banks here in India, but somewhere else in similar economies in Southeast Asia, using successfully to manage NPAs. If we look at how banks in India currently manage NPAs, you see a very dispersed picture. And these are the results from our survey, from the BANCON survey, Bank for the Future. Just look into the retail and the SME segment on the left-hand side. There is a factor of almost 4 or even above 4 between the best performing banks in terms of NPA management and the banks that actually have really troubles managing NPAs. And more interesting actually to see is also that the banks that are in the first quartile for retail are not in the first quartile in the most cases of SMEs. So there seems to be, in 2 dimensions, really a diversity of capabilities and business models and customer portfolio mixes, etc., in the banks, both on the retail side and SME. And I think this also highlights another very important aspect, that managing NPAs for different segments is also different. You cannot apply the same approaches that you use for SMEs for the retail side, or that you approach for the retail side, of course, not for the corporate, for the large corporate segment. So obviously, there is a lot of room to actually change and room to improve NPA management. And if you imagine that that the banks in the third and the fourth quarter would be able to reduce their NPAs to a level of the first and second quarter, just get to the average, that would be a huge improvement for the Indian economy. Similarly, if you look at the performance differentiation by PSUs and private banks, you clearly see a difference. If you compare the gross NPAs for the PSU, and I think you have also presented some figures of that more granular, between December 2009 and the current status as of June 2013, you see a significant rise on the PSU side. But on the other hand, you don't see a rise of the private banks. So obviously, the private banks do something different. I think it's a good discussion that we can have in the panel later on. What are the things that you can really do to improve this NPA management, and what are the differences in the segment, and what do banks do differently? Looking forward, to be honest, the picture does not look good from an NPA perspective. I remember very well the words from your governor of the RBI yesterday, who said, the NPA management is a core topic for us, one of the core pillars we want to address, in particular the differentiation between the evergreens, he called them evergreens, and the resolution cases. When is a case actually a hopeless case and you should actually go the next step and work it out? And if you look at the measures that the RBI actually has implemented and has announced, and the regulation is going exactly in that direction. It's going in the direction of recognizing what are cases that are evergreen cases, which are prolonged forever and never default, but actually are bad credits, versus what are credits that you should actually restructure already. And the results from this is actually a significant increase in NPAs, affecting, of course, the profitability and the capital side of the banks severely. The figures, the estimates that you see, the market estimates on this, on the NPA increase is about 50%. The impact on profitability and capital will be really significant. I mean, some banks actually faced a cut of 10% in the equity already from increases in provisions. So there is an increasing need also going forward to manage this correctly, in particularly the restructuring cases, managing assets well before they actually default to avoid NPAs. And this brings me actually to the next, to the core part of my presentation here, my short presentation. What does it actually need to manage NPAs correctly? What do we see actually banks in the region, in India as well as in Southeast Asia, doing well and managing their NPAs on a low level? And the differences, as we've seen, are really huge. You could think it starts with the NPAs at the end, of course, saying, yes, we need to manage our NPAs. I would argue the other way around. It starts in the beginning in the underwriting process. Of course, there's nothing that you can do right now on the NPAs in terms of underwriting, but going forward, fixing the underwriting process and selecting the right credits is actually very important. In particular, if you consider future growth areas. How are you going to manage credit risk in the SME segment, in the micro SME segment, where only a few players in the market have really experience, and the market in India is really diverse in terms of risk factors, etc. So really having the superior risk models, granular risk models, is really crucial. A result from the survey here that we have seen is the survey tells us that less than 50% of banks actually use really smart qualitative factors and really tailored factors for these specific customer segments. I think this is one of the elements that can really improve. Similarly important to the underwriting, once you have the credits on the book, is of course the monitoring process. And again, there is a lot that we have seen that leading players in the industry do differently in order to manage the NPLs. Consequence management is one example of it, and I think that is something that also clearly comes out from our survey that tells us that a minority of banks is really diligently following up on results of monitoring. This is something that can really improve. The third element on NPA management is, when I look at my experience in helping banks succeeding in NPA management, one of the core elements that drives the success in NPA strategy is the separation of duties between the business units and the workout unit. And a minority of banks only has this separation. Workout cases, in many cases, are managed by business units, and there clearly is a conflict of interests, because business units have the tendency, as have been shown in many cases, have the tendency to keep cases in their books, manage them, make them evergreen cases that go on forever without taking the right actions to resolve the cases. Just to give you a bit of a perspective what the potential is, what leading banks are doing. If you look at the performance of underwriting model, specifically in difficult asset classes like SME, where, for example, in India, the data availability is rather limited. There's not much hard facts that you can base your credit decision on. It's very much a skill game. It's a capability game of your front line. Of course, you have the credit bureau right now, which is, of course, on the retail side, exceptionally well. I think if this can be reliably established on the SME side, and particularly on the lower SME side, that will really help you a lot. But until then, until you have a reliable databases on which you can really crunch numbers, you need to really play the local game. You need to have specific factors for the regions where you're dealing with, but also with the segments that you're dealing with. The specific risk factors that tell you whether a healthcare company, a small clinic or something like that is actually going to default or not is different to a manufacturer. Yeah? And what we have seen, if you do this right, and if you select the factors right and design the factors right, you can achieve discriminatory power of these models that are comparable to very good data-based, credit bureau-based, and financial statement-based models, up to 70 or even sometimes 80% of Gini coefficient in these markets. And not in somewhere in Europe, but really in these markets, in India, in Malaysia, in Vietnam, where reliable data is really scarce. Second element, the early warning system and the monitoring process. Couple of things here that from my perspective, from my experience, are very important. The first one is you need to have a certain amount of automation. What I see many banks doing is they apply more or less the underwriting criteria on a regular basis to monitor the case. This is one way of doing it, but to be honest, what I've seen many credit officers in real life doing is doing a checkmark exercise, tick the box, yes, this is there, this is there, this is there. There's not much insight going into it. There's a lot of value in investing time and efforts to identifying the early warning indicators. That can be customer specific, that can be actually industry specific, that you monitor the industry, monitor the performance of the industry by reading news automatically with sentiment analysis, etc. There's a lot of technology available that you can also use in this data scarce environment that help you identify growing risk early on. And then there is, of course, the consequence management. And as you see on the bottom of this chart, there are three areas that you have impact with a good early warning system. The first is that you reduce the defaults. If you intervene into a customer where you see a high risk and help this customer by restructuring his finances early on, he will not go into default. That's the first element. The second element, if you see there's a high risk that this customer is going to default and you cannot prevent it, you can increase the collateral selectively for those customers where you see the high risk. And thirdly, of course, if nothing helps anymore, you can try to reduce your exposure, cut lines, avoid that he takes open lines before he defaults. So there are a couple of levers that you can actually pull that help you with a very well-structured and knowledgeable monitoring process to avoid credit losses. The third element, and this is the last element I would like to touch on, and then I hand over to the panel again, is the restructuring and actually the NPA management. And I think this might be actually the starting position where you want to start with right now in your situation, giving the NPAs that you have on the book. Again, it needs to be a differentiated and segmented approach. Retail is not like retail, and retail is not like SME, and SME not like corporate, but even within these, it's important to differentiate the strategies. You need to identify what are the collaterals that you have and prioritize the cases. Collaterals that are deteriorating, unsecured credit, you go after them first. If you have started legal procedures, there's not so much urgency that you need to take about. So differentiating this process is very crucial. On the NPA management, on the workout book, it's important to have the governance in place. The governance that you have a separate responsibility for a workout unit to manage these workout cases. Incentive system is also a very important point on NPAs. Setting the right incentives, not linear incentive schemes, but putting a benchmark in place and only rewarding NPA or workout teams against this benchmark is very, very powerful. Actually, the NPA management is unlike the underwriting credit risk management, is actually more a performance game. It's really a performance game that you can really incentivize people based on the performance they have achieved on their book. And the impact that you can have here is really significant. I mean, we have seen examples where banks have reduced their provision level by 15, 20%, or sometimes even more, depending on the current status. So summing it up, managing NPAs, of course, right now is a question of optimizing the current NPA process and really doing I would say, immediate program on cleaning up the NPA book. But going forward, it is important to fix the underwriting engine and to fix the monitoring engine to prevent actually NPLs going to happen. Thank you very much.
Thank you, Mr. Chairman. What an excellent presentation. He spoke mostly about managing NPLs in different segment is not the same, is different. He talked about different segment of banks like public sector banks, private sector banks, and how the experience is different in different banking sectors. How the new restructuring guideline will increase the provisioning requirement of banks, and how to fix the problem in three different ways or three parallel ways. One is improving underwriting standards, early warning system to improve the monitoring and recovery, and fixing the problem in different banks in different ways can ultimately save in making provisions and reducing your capital requirement. And there can be differentiated incentive system to achieve all this. Very nice, thank you so much. May I now request Mr. Arun Thutral, MD, CBIL. He will talk about his experience in retail side because they are a credit information company, lot of data, and they have studied it and how things are from their perspective. May I request him to speak here, please?
Good afternoon, gentlemen. I do not have a presentation. I am going to just share some views with you. Basically, you see, as the earlier, Mr. Mahapatra, Mr. Kremer have mentioned, that there is a difference between the NPAs of the foreign and the private banks and the public sector banks. This is basically because of three factors, which Mr. Mahapatra has already mentioned, that building an integrated credit engine with structured qualitative approach supplementing quantitative factors, developing a trigger-based early warning system, which are provided by the Credit Bureau, and developing an effective collections system that is focused on minimizing the losses. Well, the growth, compounded average growth from 2006 to now is 37%, which is very, very encouraging, and we are growing both in retail and SME sector. Just to share with you that we, as of today, over a period of time, have a database in retail which is over 300 million records. We have a commercial database which is over 14 million. We have two other repositories, which is a mortgage repository and a fraud repository. So all put together, there's a huge database available which could be leveraged and used to mitigate risk going forward. The private banks and have been very, very aggressive and innovative in using the Credit Information Bureau. They are value-added products. You have scores which not only tell you the previous behavior of the individual which you are planning to lend, but also predicts what is the likelihood of that person going delinquent in any of the products over the next 12 months. And as we say, delinquent and the defaulting, which is plus 91, as the definition goes. So that is where I believe the change would happen, and there are triggers available today. You have a credit information report, both for commercial and for retail. And if you see the retail, as the numbers said earlier, the delinquency levels have come down by half. Let's say in 2009, if there was a delinquency level of 8% in credit card, and even in the personal loan, they've come down to less than 2%, 1.6, 1.5. It'll vary from bank to bank, but that's the way it's evolved. And there's been a huge growth. If I look back, even in 2007, which was one of our best years, for the usage in credit information, which we have today in this running year, we are doubling that, which is absolutely amazing, And that is why the difference in the NPAs of private banks and the public sector bank. Though the usage in public sector banks has also been increasing over a period of time, it is not that it is not, they are not using it, but it varies from an credit grantor to credit grantor and institution to institution. Just to share with you, the biggest bank in India has adopted using credit information report very, very aggressively and innovatively, and they are now started adopting even value-added products. We have products like portfolio review, which people do. It's a must for a private bank. Every quarter, they scrub their database against the credit bureau database and look at, because when they acquired a customer, it could have a score of X, but today, how is it performing? And it also sends you an early warning signal that if somebody, borrower has gone delinquent with one institution, you will need to do a due diligence why it is happening. Because it could sooner or later hit you. And you could also have a problem and your NPA, it could become an NPA over a period of time. So these are products which you can use. You have triggers which actually you can give your portfolio, a set of customers which are very critical to you. And we will watch them for the institution. And if there's any little change in the profile of the customer, we will be able to send you an alert online instantly. So you could actually take preemptive measures before anything happens and you hit problem. So that's where I think credit information can play a very, very critical role. And you're all bankers. I'm sure many of you are familiar with CIBIL products and you're using it. But I think the biggest change is that the approach towards managing risk has to change, and we need to adopt what private banks are doing. And if public sector do that, I think there's a huge potential and growth possibilities in this country. Thank you.
Is it audible? Okay. Thank you, Arun. Now another Arun will replace this Arun. But before that, let me try to sum up what Arun tried to say, is that he runs the biggest credit information company in the country, the CIBIL. And his experience, or CIBIL's experience, is that the delinquency rates have come down in retail segment by at least half because banks have started using the credit information from the CICs, credit information companies. But the challenge is for the public sector banks, which have not tapped this source of information more frequently or more vigorously. Private sector banks have used it to their advantage, whereas public sector banks have not. So there is a learning point for all of us, particularly how to use the CICs. At least in the retail and SME segment, they're quite strong now. One can tap that resources. Thank you, Arun. So I now request Mr. Arun Srivastava, ED, Bank of India. He will give his perspective of how or what steps they are taking in their bank for improving the NPA position to recover bad loans. Arun Srivastava.
Good afternoon, the distinguished audience and the panel members who are here. As rightly pointed out in the initial two presentations, that NPA is a situation we have to live with it. It's a part of the economic process, then the asset quality will be at times under stress. As in the first presentation, Mr. Mahapatra gave that in starting from the 1997, there was from 15%, we came down to 2008. We were the lowest in the gross NPA, and they started rising again. Probably if you see that the slowdown effect started from 2008 onwards. So that is how the asset quality of the banks cannot remain insulated from the outside factors or the economic factors prevailing in the country and worldwide. So that is how the situation it is there that we have to live with that. But how to contain it, how to address the problem, that of late in our bank we have taken certain steps and which has enabled us to curtail our stressed assets to a certain extent and show a gross improvement in our gross NPA and the net NPA. We have in our bank a system of catching early warning signal systems. From the day one, the signal, it's an automatic system which gives you warning signals of an account which is not paying on the due date of the installment or the interest it gives us, and there is a dedicated team which follows it up with the grassroots level, with the branches, and at times in the case of the large borrowers, with the borrowers itself, that why the account is showing a stress, why the repayments are not coming on due dates. We have now started coming up from the what you call as a financial from the operations itself. Now we are migrating to the transaction and the financial system as well, whereas in case of a large corporate borrowers, we capture where the EBITDA positive on a quarterly basis. So just to indicate, not going by the default, wait up to the stage of a default in payment of interest in installment, but to capture any operational deficiencies in the account on the financial front, which are likely to throw up a warning for us in the coming months. So that stage also we have started capturing those accounts and try to address them, have a dialogue with the borrower in the initial stages. But having come to know that the account is not likely to come up to the terms of the original repayment, we have a system of deciding on whether the account has to be restructured or not. It is better to address the disease rather than the symptoms. So we address the disease, we try to analyze what is the reason. Most of the stress assets are probably from the infrastructure or the sectors which Mr. Mahapatra indicated. They are interconnected with the infrastructure sector, except for the textiles if you go. So there are reasons which well known to the industry, and then we address these accounts possibly on a very softer term so that they, in the longer run, the cash flows are sufficient enough to repay the debts. But if there are certain weaknesses or the account is not likely to come up, then we have a process of a recovery, and we take the actions very fast so that the asset which has gone bad, we are able to recover in good time so that before the asset quality or the value of the securities are eroded to that extent. But as far as possible, we try to restructure the account in the initial phases where we find that it's a genuine case of a restructuring and not an evergreening, as the governor rightly pointed out yesterday. Because we also want to save the economic value of the asset in a longer run. We have in the last quarter, we have done after quite many years, we have tried to make a sale of the assets also to the asset reconstruction companies, besides harping on recovery in the smaller accounts and the larger accounts, so as to knock off those assets in our books, because we thought that recovering those kind of assets is not our core competence, and let us use this money recovered to optimize our resources and use it for better assets recycle those assets. We have found that that was a very good exercise we have taken for sale of the assets. One or two banks also have done this kind of asset sale in this quarter, and which has enabled us to save our provisions for the quarter and given us some kind of income to optimize our capital for the coming quarters. And that is how we have been able to contain our slippages, try to show an improved recovery performance, and save on the provisions. That is how the provision coverage ratio has also improved, besides reduction in the gross and the net NPA. That's all. Thank you.
Thank you, Arun. Very nice presentation. He spoke from the perspective of his bank, Bank of India, how they have tried to total the NPAs. He started with a very good positioning. Why NPAs have risen over the last few years? Because the economy. Economy has ups and downs. And when the economy is in downturn, I mean, you can't expect that asset quality to improve at that time. It can only deteriorate. So it has come down. And his bank, like catching them young, they want to catch the NPAs at the early stage, developing early warning systems. Even if some deficiency in the operations of the borrower's account, they try to catch it. And immediately after that, have a dialogue with the borrower. If it can be restructured, if the assets of the borrower can be restructured, it's good for the economy, good for the society. Otherwise, they can go for the recovery. And for recovery, they are not the best people to recover, because there are agencies now, separate agencies like asset reconstruction companies, who have the core competence to do this job, and they are trying to sell those assets to the ARCs and thereby optimize their capital and provisioning. Thank you, Arun, for the nice presentation. Now, the biggest bank of the country, State Bank of India. We have the privilege of the DMD being here, Mr. R. Venkatachalam. May I request him to give a presentation from his bank's perspective and how they are trying to optimize capital, particularly in these bad times. Thank you so much.
A very good afternoon to all those present here. Now, I'll give a small perspective about what has been happening in the system and what is being done in State Bank of India. As Mr. Mahapatra was saying, he showed the graph when the NPAs were at a very high level of about 16 to 17% during late 90s, and it came down. Thereafter, it has increased. Now, I have seen through that phase. The biggest companies of today, which you see, Jindal Steel, SR Steel, so many steel companies, various other textile units, they are all passed through this phase. Today, those days they were still, growing. Today, they are some of the biggest in the world. So the growth has its pangs. And as the country grows, as the industries grow, there will be difficulties. But then they pass through that and they survive and they become quite big. Now, that is a phase which is happening now also in this country. Those days, there used to be nothing called as infrastructure. But the infrastructure started early 2000s it started. Today, it's at a phase where it is also passing through the same pangs. And infrastructure along with that carries steel, iron and steel, cement, various other segments. So all these segments are also having difficulties. But as we pass through this, as the regulations come into force, systems are streamlined, I think we'll again see that things start looking up. But this time, apart from whatever has happened during the late 1990s, there is some difference. Last time, it was mostly within the country. But this time, we are also affected by what is happening externally. What's happening in Europe, what is happening in US, what is happening elsewhere is also affecting us. We are not immune to what is happening outside now. We have freed ourselves. We are becoming more and more open with the rest of the world. So when the rest of the world gets affected, it affects us also to a certain extent. Added to that, when there are some internal problems also, the problems get magnified. But then, always there is a good tomorrow, and the country is actually passing through that phase now. The regulator is taking steps, the banks are taking steps. At the end of the day, I'm quite confident that we will come back to the similar level which we reached in 2005, 2006. Now, coming to what action State Bank of India is taking. What is State Bank doing? Now, there is a very full-fledged risk management department in State Bank of India which takes care of various risks it has. See, State Bank of India is not alone. It's a big group. It's a conglomerate. It has got various subsidiaries. It's got associates. So we have got various types of risk departments. Within the department, we have got different verticals. The biggest one is, of course, credit risk management. Then we have operational risk management. Then we have market risk management. We have huge investments. We have group risk management. We have system risk management, IT risk management, because I think our system is one of the biggest in the country. And we also have an overall enterprise risk management for the bank, the group as a whole. Now, what do we do? I'll take credit risk because today that has been the main topic. Now, under the credit risk, what are the things which we have been doing? We have been slowly building up the department. We have to identify the risk. We have got several stages. One is risk identification. The second is risk measurement. The third is risk control or the risk mitigation. Now, under risk identification, we have to look at the quality of the accounts, quality of new accounts, quality of existing accounts, what is happening to the existing accounts. Now that we achieve through several models which we have built up. In fact, we have got 27 risk models for various types of activities, various types of industries, trade, and we do work upon that. We also take the external models into account, but we have our own internal system. Now, as we are moving into the internal risk-based approach, that's the advanced approach under credit risk management, we are again improving them upon. We have consultants with whom we have been discussing. We have been discussing with the Reserve Bank of India. They also come and look at the manner in which we have been building our models. So we have been continuously improvising. And during the times of stress, the models also become very robust. So we keep reviewing the models also from time to time. Then we also have several stress scenarios. Now, the stage at which we are passing through, there are several stresses which the industries pass through. We try to see what is the level of stress which was anticipated, what is the level at which we are there now, and how much, up to what level can it go? At the highest level, what will be the position in respect of NPAs? What will be the position in respect of the need for additional capital? Because additional NPAs also cause stress on your capital. So what will be the additional capital that will be required? So what are the steps which you will have to take? So there comes the measurement. What is the measurement? How is it measured? Okay, so what will be the level up to which the stress can increase? So we analyze. And for analyzing, we have been building up excellent data systems. We have set up a data warehouse from where the data is all pulled. From one place, the data is collected. Our MIS, we have been trying to build up on this basis. We have been largely successful. I think a short time, some more time, I think we'll be able to build up a very, very robust system of MIS. And we have, once we identify what are all the risks, then how do we, whether to take up a particular unit, whether to lend to it, whether to increase our exposure, we have got certain levels. We measure the risk. We have got various, we call it as, on a 1 to 16 based rating, we identify the risk levels, and we say only for each sector, we have a certain limit, beyond which we will not want to take any exposure. That's the cutoff. And there are certain levels where we feel that we have to take more than adequate care. For example, we may insist on higher levels of collaterals. We may insist on higher levels of caution, involvement of the promoters, pledge of shares, so many various precautions we'll take. And supposing the units have been, now these are different for the units which have already been with us for a long time and for new units. Because those who have been with us for a long time, We know them very well. We know the management's capabilities. We know whether they'll be able to keep up the promise. So we differentiate between the existing and new units. And we also, what I'm saying is we are stressing on the quality. And the quality level increases with the higher stress. The higher the stress, the greater should be the quality. This is how we have been working on. And apart from that, now when I come to capital, I'll say we'll have to increase the pricing also depending upon the risk factors. Because higher the risk, the greater will be the capital that will be required. So we'll have to increase the pricing in respect of high-stressed accounts, whether they are in the books or those which are coming to our books. Now, I also told about the risk models and the stress scenarios which we build up, which we work on, and then the risk mitigation measures. Now, there are various risk mitigation measures. We do have a very stringent system of following up the accounts, whether they become stressed, whether the accounts become irregular, whether the accounts are passing through a difficult phase. We have the alert systems. We have built up the alert systems. We have the stress management monitoring systems at various levels, starting from a very, very low level at the regions, up at module levels. Then we have something called as circles. Then we are called at the corporate center level. We monitor at different levels. Now, based on that, we also take action. We deliberate. We call the customers. We discuss with them. Then we try to see whether they need any hand-holding assistance. Where they need hand-holding assistance, it has to come out very quickly. Otherwise, the account will move into severe stressed portfolio. So we monitor them. We try to restructure if they require restructuring, provided they will be successful. The techno-economic viability study indicates that this unit can come out of the crisis. Now, if they cannot come out of the crisis, there is no point in assisting the units. Now, if they can come out of the crisis, then it's absolutely essential that we should help them, because creation of capital is one of the most difficult things in this country. So wherever capital has been created and where there is possibility that the unit will survive, we'll have to assist them. And we do that despite the fact that we may get a bit hit initially. We always look for the future, because once this unit comes out of it, whatever capital we may have provided for, we get them back. So, and another factor is the employment which these units generate is also one of the factors. The social factors also we take into consideration when we take care of the when we do restructuring. Now, if restructuring is not successful, then what do we do? Then we try to sit for discussions with the companies concerned, the promoters, to see how much we can salvage, how much they can pay off in the given circumstances without going through litigation. But if that doesn't succeed, then necessarily we'll have to go through litigation, and there are various modes which have already been discussed. There are SURFACE, there is DRT, there are various methods. Now, while over a period of time, a lot of additional monitoring mechanisms have been introduced. As Mr. Tukral told, CIBIL and other CICs looking to their sites to look for early warning signals to see whether the borrowers have availed funds everywhere, they have defaulted elsewhere, whether the companies have defaulted elsewhere. That is one. Then registration of the mortgages through CERSAI, that is another new thing which has come about. Now, there are various ways in which we try to monitor, and this is the way we have been monitoring the accounts, whether it is retail or whether it is corporate. Now, one of the most important things which the bank looks at is the risk management architecture. We have a full board of directors as well as the senior executives who monitor the risk profiles of the accounts, the risk profile of the industries from time to time. We have risk management committees. We have risk management committees headed by senior executives. Then over and above them, risk management committee is headed by the board members. Then we have the executive committee of the board. Then we have the central board consisting of all the members of the board, senior directors, executives, everybody present to monitor these accounts. So over a period of time, the bank has been building up its systems, procedures, the monitoring capabilities by training the senior level executives and passing on these perspectives down the line. The idea is over a period of time, risk should be there in the blood of every executive, every staff of the bank. One should sense that there is risk in every activity, but then risk should not become a hindering factor. One has to understand that there are risks, and taking care of the risk, understanding the level of risk, one has to take the exposures. Now, this is how we have been functioning. We have been trying to train the staff. Now, by improving the quality of the accounts, we can reduce the level of capital that is required. With the same capital, we can lend more, we can earn more. The profit can be increased, because at the end of the day, the profit is what counts to a shareholder. What he gets from his investment is what matters ultimately. So there are various ways in which we try to improve upon this. One is by reducing the costs. Reducing the cost means we'll have to improve the quality of the risk-weighted assets. Now, the quality of the risk-weighted assets is taken care of by improving the quality of your analysis, the quality of your assessment, the quality of the decision-making, and the quality of choice of the accounts. So the better the quality, the smaller will be the charge on the capital, and the larger can be the lendings, and lesser the provisions, the lesser the NPS. This is how we have been trying to improve upon our portfolios. This is how we have been trying to improve the capital performance. And of course, once these are there in place, I think getting money from the shareholders will not be a problem, whether it is the government or the general public or the existing shareholders. So, overall, I'll say we have been working in the right direction, but in difficult times, it will look as if things are all very difficult. It will look as if PSUs are going to, they may not survive. They will go off any day. But if you see the history, I'll say it's not so. The same level of stress was there. In fact, a very higher level of stress was there in the late 1990s. Subsequently, everyone came out. So once you take the correct action, I think the survival will be easy. Now, one more thing I have to say is the risk management, this one has completely changed over a period of time. We have become more and more aware of what is happening around us. We have the conditions, the capital required have all substantially increased. Despite that, if you see today's level, it's much less than what it was in 1997. So overall, I'll say it's not as bleak as it's thought out to be. And what Mr. Mahapatra showed in the first his presentation, the green, most of them will become greener, I can tell you. Thank you very much.
Thank you, Mr. Venkatachalam. Nice presentation. Let me try to summarize what is said in little. He said, this time is different. You know that great book, this time is different. Probably this time is different. This NPL problem that we have in India today is different, mainly because of three reasons. One, growth has its own pangs. We grew in very fast pace, almost 8, 9, 10% for about 4 or 5 years. And probably the underwriting standards were loosened during the growth time. That normally happens. Second, this time is different because a lot of the loans have gone to infrastructure sector. The old institutions we had earlier, like the IDBIs, ICICIs, and IFCIs, are no more there. They're not lending to infrastructure in that way. So the burden has come to the commercial banking sector, particularly the PSU banking sector, and the burden is really showing now. And third, India is no longer isolated. It is integrated to the whole world. And when the entire world is suffering after the financial crisis, how can we expect India to be different? So the spillover has to be there on India, and it has really spilled over. And he talked about the way State Bank is trying to manage this problem. They have created risk management verticals, more so credit risk management, starting from identification, measurement, mitigation, and how to optimize capital, and how the new institutions like CICs, ARCs, new laws, the DRT and SURFACE and the SERSAI are helping the system to mitigate the NPA problem. Thank you so much, Ayan. Now may I request Mr. Jairam will come now. I think Jairam Mohan. Please, Mohan Jairam. He's the MD of Experian, a credit information company, and how they see from their point of view. Thank you, Mohan.
Thank you, sir, and a very good afternoon to everybody present here. The slightly unenviable task that when you're coming in second last in such an eminent panel is most of the good points are taken. So I'm going to try and focus on the ones that aren't taken, and say good luck to Mr. Rudran because he's coming in last. Broadly, what I thought will be useful to do is to talk about things from the point of view of the CICs, with particular emphasis on what's happened in banking over the last couple of years. If you look at Experian's profile, Experian basically is the largest credit bureau company in the world, also running a large analytics offering set world over, present in about 80 countries, running bureaus in about 19 countries, etc. The focus of what I have tried to do is to try and see if we can pick up from some of those experiences and look at what's happened contextually over the last couple of years, overlay both of them, and come out with what I would term as I was actually going to say global best practices, but I'm realizing that in the current context, at least specifically in banking, global best practices don't seem to mean too much nowadays. India has actually done a much better thing in terms of controlling risk over the last couple of years. But pick up the best practices, so to speak, and put them in the context of the banking industry over the last couple of years. Just walking through the points that we talked about, the speakers prior to me talked about, there are a few things that are worth observing. One, we take just a period between 2011 and 2013. There are, if you look at the different asset categories, there's one asset category that significantly stands out as actually having had a reduction in risk profile. That's retail business. If you look at this intervening period, overall gross NPA levels have risen by about 1% in this period, in the 3-year period that I'm talking about. Corporate risk has actually gone up by about 1.7%. SME risk has gone up by, say, roughly 1%. Retail risk has actually gone down by about 1.5%. Now, contextually, what is exactly going right in retail? And maybe, if you put another dimension to it, we seem to see that in certain retail banks, perhaps the overall gross NPA levels are going down, whereas in some of the other banks, they are not. I mean, if you cluster them, obviously there are some differences. But if you put both of these dimensions together, asset category and, let's say, bank classification, and look at the best practices and the reasons why some of these asset categories or certain banks are showing a declining trend in gross NPA levels, there are 3 things that come to mind. And what I would famously refer to as our ABCs of, let's say, gross NPA management, capital optimization, and so on and so forth. A, standing for automation and analytics. I mean, what significantly happened between, let's say, 2008, 2013 is that most of the banks who have been going into retail have started investing significantly in automation and into analytics. You heard Mr. Venkatachalam, who came in earlier and mentioned data warehousing. Of course, we can't not mention the automation that's happened in that bank either, or many of the other banks that have been in that space. So the big thing that's happened is this automation has actually helped in trying to put a structure around how you can manage risk. How does that help? It helps because it basically ensures that processes go through some level of similarity. You don't have different processes that are happening in each region or in each branch. There's some semblance of uniformity that you're able to bring in while handling exceptions. So so the question is, do you then not require human intervention? Yes, you do. I think the global learning has been you certainly require human intervention, but you perhaps need it for about 20% of your cases and not for the remaining 80%. If you can get automation to work on 80%, you're in a good place. So staying on the A, I said the other A was analytics. And if you look at significantly what has happened in the same time is the number of banks that have started using analytics, scoring, etc. in their underwriting practices has actually seen a significant rise. And that again is something that we believe is strongly contributory to the reduction that we are seeing in the risk levels overall. How does that help? Why does that really bring down NPA levels and such? Again, going back to one of the points that Mr. Venkatachalam made, whatever is coming in is what will result in NPAs or non-NPAs. So if you bring a risk culture and if you bring the right set of processes in, what will come in at the end will be a good set of let's say loans. Analytics actually helps you differentiate by looking at past experience and figuring out how you can predict for the future. And to that extent, helps you pinpoint the practices that, in some sense, will differentiate a good loan from a bad loan. So, like I said, the A, automation as well as analytics, I think have been one big differentiator in the reason why we have seen the reduction in risk come through over the last couple of years as far as retail business is concerned in India, and I'd say with good banks across the world. The B is, and again, Arun mentioned this in some form, but I'll emphasize on a couple of points there. Bureau usage. The great thing that's happened in India, and it's happened to my mind as a sort of a silent revolution, that the Reserve Bank has brought in, is that we've had a positive data reporting structure over the last couple of years. The significant point to be made here is, I mentioned earlier that Experian runs about 19 credit bureaus. There are 4 or 5 geographies which actually have positive data sharing. The progressive thing that we did in this country, the regulator brought in this country, was we started off with ensuring that positive data was shared across the banking system. And the reason why that's a big differentiator is positive data helps differentiate risk as well as customer behavior way better than just negative data. You will be able to see the performance of an overall customer, individual, across his multiple loans and take a comprehensive, clear view. You'll be able to monitor things like leverage way better than you would have been able to do it in just a negative data environment. Developed countries like Australia, France, etc., are just starting on the path of moving towards positive data. The great thing in India is that we already have a bureau system that's reasonably vibrant, 4 CICs in the country, and a positive data environment. Wonderful place for us to be in. So increasing bureau usage, IFC studies have concluded multiple times over that in any economy, whenever you start seeing increase in bureau usage, generally systemic risk starts coming down. Why? Because there's a disincentive, natural disincentive for people to not be honest. They know that they can't cheat the system, not take a loan from one bank and then go to another bank and try and play the system. So to that extent, the bureau infrastructure and I'd say the positive data environment that the Reserve Bank as a regulator has brought in, I see as a huge positive, we see as a huge positive, and which is why I said that that's your B of the differentiation. The third part, which is the C that I mentioned, was relating to collection practices. Again, Mr. Arun mentioned it when he talked about some of the practices that they have put in place. But if you look at it in totality, the big difference between a great collection system and a not so great collection system is the process that goes behind it. One way of doing it is the way Mr. Venkatachalam indicated, trying to make it a part of the lifeblood of the organization by building a culture of risk. In some form, adding to it needs to be a reasonable process that is actually followed as far as collection is concerned. If you're able to bring a reasonable level of uniformity, it's been proven time and time over again that having a properly stated process that you're following through the life cycle, starting from early warning signals, moving all the way up to pre-delinquency management, going on to delinquency management, significantly impacts the ability to collect from a loan. Just reminding customers at the right time, moving on to the phase of putting in the right level of practices, helps in a very significant manner. So the C is again something that is fairly important in terms of establishing a uniform process, and that again is something that has happened fairly well over the last couple of years as far as the banking system is concerned. So, not wanting to take too much more time and just emphasizing the key messages, I'd say that these are the 3 practices that we have seen in India that have actually resulted in banks being able to show a difference in their asset quality over a period of time. Improvement in quantity of gross NPAs going through. And the same practices have also shown themselves as being equally relevant in the international domain. A, automation, analytics. B, bureau usage. C, collection. I think significantly for the retail and the SME segment, these are aggregate parts of the portfolio. Corporate depends a lot more on individual discretion and on individual processes. But if you look at these two businesses, they are driven by aggregates. And having these three differentiators to a great extent ensures that you are able to make a big difference. I think I'll stop there and take any further questions if there are any. Thanks.
Thank you, Jaraman. He, in fact, brought a new perspective that over the last few years, 2011 to 13, why you have seen the NPLs going down in retail segment, but going up in corporate and SME. And he attributed to the ABC, I mean, the automation and data analytics. Second is the bureau uses, and C is the collection practices, how it has improved the NPL situation in the retail. Whether the same can be replicated for corporate and for SME. SME, yes, people have done a lot of work. For corporate, I can share with you, Reserve Bank has already announced that we are going to create a credit registry in which all the corporate loans given by the banks and other institutions will be reported to that credit registry, and all the banks can take the data from there. The data can be shared with all the lending institutions. Maybe that is the future. Now, let me invite the last speaker of the today, but not the least, Mr. Rudran, who is the MD of RSIL, the largest ARC, asset registration company of the country. Probably when the dead body goes to the mortuary, probably his role is more important than all of us. I mean, we create, give new birth to loans, but ultimately there is somebody who can take care of the death of a loan also. Mr.
Thank you, Mr. Mahapatra. My distinguished persons on the dais and distinguished persons in the audience. First of all, let me thank you for giving an opportunity. The RBI has made some estimates on additional capital requirement for domestic banks, and which is for meeting the Basel requirement by March 2018. It comes to around 5.55 trillion, which is a huge amount. It is in this context that we have to see how the NPAs, how the recovery from the NPAs has to take place. And recovery from the NPAs is very important tool for which will lead to the capital optimization. And it is in this context only ARCs are involved. Actually, the ARCs were set up for resolution of NPAs, but if you look up the growth of NPAs and the business of ARCs, you will find that there is a diverse proposition. That means the business of ARCs has not, for whatever reasons it has not commensurately gone up like the NPAs. I'm sure that ARCs can help a recovery in a very big way. And for this purpose, certain suggestions which I would like to make is, banks may consider the ARCs as a strategic partner for resolution of NPAs. In fact, a lot of value maximization can be done if ARCs are associated, particularly from the debt aggregation point of view, because currently the ARCs in India have a very good skill setup, which, with highly professionalized staff, which can be used for recovery as well as for reconstruction. In fact, if young NPAs can be offloaded to the ARCs with a debt aggregation process, this can be restructured and the money can be recovered, the economy can be benefited by that. Of course, when specialized institutions are there, I feel that there is no useful thing that will be achieved by duplication of the systems in the banks and institutions, because particularly, because these resources can be profitably used for their core business. Of course, there are some sort of limitations to the banks also, particularly from the accounting point of view. If the assets are sold on cash basis, they are not able to book the profit, because the instructions and the guidelines are different. Of course, if it is sold on SR basis, and according to me, the sale of NPAs to ARCs on SR basis is the best means to achieve both ends, not only from the recovery point of view, but also from all other points of view, because, as far as SRs are concerned, the selling bank or bankers stay invested and interested in the recovery of the NPAs, because until the recovery is over, they will not come out of the investment position. And this can be strengthened also to a great extent with participation of the banks and the selling banks along with the recovery. This will also give a good value. Maybe that, even from the much feared CVC, CBI point of view also, because in the case of SRs, if value is recovered at any point of time, at the end, it can be shared with the seller bank. So there cannot be a question whether the assets have been sold at a lower value or an unrealistic value. That can be very well settled from the resolution. Regarding some tools for management of the stressed assets, I think we have seen here itself in the recent time, in the current year itself, some of the banks which have offloaded the NPAs to the bank, to the ARCs, they have been able to reap the benefit out of that, because they have been able to contain their provision requirements, and also wherever cash sales have been done, they have been able to also increase their profit margins, as a result of which the interest of the stakeholders have been improved, and the value of the shares, in fact, in the market, it has gone up substantially. Then, when we were talking, some measures, I think there is also a chance for a proactive action from the point of view of containing NPAs and recovery of NPAs, that even before it is becoming a NPA, when in a stressed category, I think if proactive steps are taken, perhaps the NPA position can be prevented to some extent. And some measures to dilute risk on stressed assets is strengthening of credit appraisal techniques, then scientific analysis of information about unit, industry, financial management, etc., and centralized credit appraisal and monitoring team, close monitoring and periodical review of accounts, competitive risk analysis and compliance in terms of conditions of sanction, as also deployment of latest credit risk management techniques. I think these measures will go a big way in reducing the NPAs. Thank you.
Thank you, Mr. Rudran. Now we have posed, actually he basically stated that how the growth in NPLs is not positively correlated with the business of the ARCs. I mean, if there is a growth in NPLs, there should be increase in the business of the ARCs, but that has not happened in our country. There is a lesson here that we have created specialized institutions to take care of specialized jobs. But in the public sector, probably we have the fear of CBI or CVC. We are not able to sell the NPLs to the ARCs. But he has given you a good suggestion that if you take the SRs for whatever value the NPL is as on today, but if there is upside, you always gain. And it's not that the ARC will gain, but you also will share in the gain. So the SRs has upside to it, so you can sell your NPLs to the ARCs and not be afraid of the CBI or CVC or all these things. And He also, at the end, he talked about how to improve the risk management systems in banks so that you don't generate NPLs. If you don't generate NPLs, you don't generate business for him also. Okay. Let that be as it is. We have spoken about the problem, but going forward, how do we go about it? May I request Andreas to throw some light on this?
Yeah, thank you very much. We talked a lot about the machine room tonight. This afternoon. The machine room of how to underwrite, how to make early warning, and how to manage NPAs. What you see increasingly also in the industry is that risk management becomes also a strategic partner and gets out from the machine room to the boardroom. And I think that's a role that is increasingly important in India. And I just want to give you two examples how risk can really help in strategic decisions. The first example is really when you think about the future growth of the bank that you are working in. In the past, very often, it was always a discussion about where is the growth in the market and where's the margin. It's increasingly important to also take a risk lens on it. And risk should actively drive this discussion, providing inputs into the strategic discussions of where to grow, in which SME segment, in which region, in which industry, with the dedicated perspective of what is the inherent risk in there, and what are the bank's capabilities, and what do you need to build up in order to succeed from a risk management perspective in these industries. We've seen many banks fail in this, in particular in Europe, and if I draw from my European experience here, and what I would like you to avoid in the future, many European banks had invested in assets, in credit risk they did not really understand. It was a pure margin game, it was a pure growth game. All the investments into Eastern European markets, all the investment in structured credits was always driven by margins. There were no risk ownership. There were not natural risk owners of these risks because they didn't understand them. And I think that is something that the European banks have learned, and I think that becomes also increasingly important in India. When you look forward, what are the growth markets you want to go, and what are the capabilities that you need to put in place in order to grow there? And their risk really becomes a decision partner in the boardroom. The second aspect, we have also the stressed asset in our title of this panel, but we didn't talk a lot about stress testing actually here. In this group, and I think that is also a very important point. Stress testing is not a regulatory exercise. Of course, there are regulatory requirements for stress testing, but stress testing should actually help the management. What many banks struggle with is they do regulatory stress testing, and then they present the results to the board, to the managers, and then they say, yeah, what do we do with it? And nothing really happens, no consequences are happening. So it's important to understand, to position stress testing differently, and use stress testing as a decision tool for the board, for the management to take actions. I think this is actually something I would like to highlight here to get a bit of a forward-looking perspective, what role risk management should play in the future.
We have conspired against you to deprive you of many questions because we are now running short of time. We still have 2 minutes or 3 minutes, or if the organizers allow, maybe 4 or 5 minutes time. Before that, I have summed up at the end of each speaker's presentation. I don't want to do any sum up again now, but what I would like to say, yes, we all recognize that there is a problem, there is an issue, nobody is wishing away the issue, but it is not alarming, and we have systems in place, we have institutions in place, and ultimately I like Mr. Andre Tremer's last word that NPLs is not a regulatory problem. It's not my problem. It's a management problem. It is your problem. So, you have to find a solution for that. But some of you were here yesterday. Governor spoke about we are working on a system. We are working on a, what should I say, a system to incentivize banks for early detection of NPLs. We are also working a system to incentivize banks if they monitor the NPLs and if they go for a fair resolution of the NPLs. It is a weeks away from today. The governor spoke about it yesterday. So we are working on it, and in a week's time, weeks in plural, not 1 week, in a week's time, we'll come out with our scheme. Please wait for that. But in the meantime, we have to recognize the problem, we have to address it, and we have to do our best to get out of this situation as early as possible. May I now ask a few questions from the audience? Otherwise, I'll be failing in my duty. Please.
When banks are selling the assets to ARC on, say, SR basis, so 5%, suppose 595 formula, 5 is of ARC and 95 from the banks. At that time, the final say in respect of sale of the assets, underlying assets, as per the current guidelines of the RBI and the ARC guidelines, bank doesn't have the final say in sale of the underlying assets. Can we look into it? Because we are having 95% stake as a SR holder.
No,
Banks,
your question is, for selling the asset to the ARC, banks should finance the ARC?
No.
No.
We are investing in the SR, sir.
Yes, bank is investing in SR.
Yes. As an investor in the SR, my stake is high, 95%.
Yes.
Why banks should not have a final say in sale of the underlying charge assets?
Okay, you want to say, as a SR holder, why banks do not have a
Final say? Yes, sir.
Okay, I mean, I'll think about it. I really have no ready answer right now.
Please.
We'll think about it. But presently, yes, you don't have a say.
RBI guidelines doesn't permit the...
Please answer.
Presently, I think the ARC, which is the trustee for the trust, which is doing the recovery, they will have the final say. But his point is that since he is holding 95% of the SRs in that trust, he should have a final say. I think it's a quite reasonable request.
Any other question, please?
Sir, we will be a little brief. Number one, the prevention is better than cure. The economic condition is not good. The reality, everybody is aware. Steps are being taken by central government, Reserve Bank, banks, everywhere. But the way in which the problem is growing and the way in which it is being tackled is very low. So there is a need of attend to that area by this more from the government machineries and some way, limited way by the Reserve Bank. Other part is that because of the, the economy problems, cash cycle has prolonged. There is hardly any place where a 90 days real payment cycle comes from raw material to the finished goods. Exceptional may be there of monopolistic item where the investors are in between traders who makes more profit. But real cycle is not that short. Say the 90-day cycle was ideal one, decided this that long way. But when there is no real cash cycle, there is need to think out of box somewhere. And the other part is that, sir, the RCL and all that issues, somebody has to sit and analyze why it has not materialized. Because the RCL or any asset reconstruction company, their pricings and the market value of the securities were having a long gaps. So if some realistic and more open, more democratic, mechanism comes, then it may grow. But the biggest problem is that the money cycle linked to economy cycle should be understood and some corrective step required.
Yeah, I understand. But 90 days is now an international norm.
I know, sir.
If you make it 180 days or so, it will be a retrograde step. Then what will happen? People will not believe in your numbers.
No, sir, 90 days okay.
Yes.
Let us see that how 90 days is implemented. Presently, if somebody makes payment, makes default, is free. The civil court will take its own time to decide. Even our DRT suits, They are taking too long time to make out.
I think
If that machinery is tightened up, it may help.
The law has been amended recently for the DRT Act. The lawyers cannot take many adjournments, I think limited to 2 or 3 as per the new amendment to the DRT Act. So things will improve from that point of view. But let us think what we can do from our house, I mean from the bank itself. I mean, let us not throw it in the other person's throat. What we can do in the bank itself. I'll ask, I mean, one, yeah.
See, I can answer.
The time is up.
Yeah, I can answer here. Now, when we do the assessment, we'll have to factor this. Suppose 2 years back, the realizations were taking place in 90 days. Today, it may not be taking place in 90 days. It is not taking place in 90 days. Let us face it. So, we'll have to give a longer period. There is no other way as of now. Because you can't tweak the law, I can't tweak the law. But nevertheless, the business has to run. So, we'll have to be more realistic in fixing up the receivables period. Yeah.
Regarding civil, I want to just share with Mr. Thukral. In civil reports, what we found in practical scenario, private banks or the foreign banks have reported many things on the credit card issues. Rather than the nationalized banks, having seen that most of the, not reported in the, even if in the bigger amount, say crores of rupees. In that scenario, if we can segregate into 2 parts, in case of the credit card or OTS of suppose 850 rupees OTS, but for that huge embellishment during appraisal with the bankers to write in the appraisal note huge paragraph prominently written. So for that you should have a window where the small issues are there should be addressed and can be taken care of. That is number 1. And number 2, regarding your CIBIL, it is mostly in the banks, it is taken as a private document. If it is a right to information or available to the customer also, and he gives a sufficient evidence given to a committee satisfying that it was not the reason, something else is that, and that things can be dropped down at civil level, then it will help the bankers to appraise at an early, it sometimes takes 15 days or more to resolve.
Let me answer that. For one, the report is not a private document with the bank. It is available direct to consumers. We have a service called direct to consumer. If you go on our website, there is a form which you can fill on the website, and you can give your details and identification number, and you can actually, once you go through the authentication tool, as we have totally automated it, you can actually get your own report, and you can see the same picture which a banker would see. So it is not that, and it is much more friendly. We give a lot of FAQs, answers on our website. I would suggest you go there. And we also have a dispute resolution format, where if you have an area of concern and you want to challenge anything in the report, you can actually fill that up, and we will take it up with the concerned credit grantor and come back to you to resolve this issue. So it is available. I would request you to kindly go on our website and go through the process.
Okay. Mr. Kramer mentioned about workout. While we know that workout happens in the SME and the corporate loans, but on the retail side, very little work has happened on the workout, which is restructuring. Considering that we are going through an economic downside, don't you think it is important to have workouts on the retail loans, especially on the housing loan segment, where PSU banks have taken sizable positions in terms of new origination, considering that the regulation do not encourage, and that's primarily because of evergreening of loans, that if you restructure a retail loan, it stays NPA for the next 12 months. Considering that people have lost jobs, it is important to make them stay at their house till the time they get another job, and maybe credit bureaus can come in and assist the banks in letting them know of borrowers who have good track record and who needs to be given an opportunity for a restructuring whereby he's given a moratorium or something to...
I think we have issued instructions that keeping the EMI constant because of rise in interest rates, if you can lengthen the loan repayment period, it is not restructuring for retail housing loans. Am I correct? I think, yes. Yeah, so that instruction has already been issued, if I remember correctly, in the year 2009 or 10. It's not a new instruction. So for retail residential mortgages, keeping the EMI constant, and if you are not, because the interest rates has gone up, the loan can be lengthened. Okay. I think we will stop here. Please pardon us for that.